You're just in time for your weekly most comprehensive look at the world of business and economics. It's been about a year since we began the COVID-19 intervention measures, and on the front line of this was the banking sector, and we want to take stock on that with the Chief Executive Officer of the Kenya Bankers Association, Mr. Habil Olaka. Welcome on set.
Thank you. Thank you.
Habil, the latest data from the central bank indicates that 54% of the banking sector loan book is now restructured. When I look at that vis-a-vis the fact that we are at NPLs of 14%, sometimes I get a bit worried. Do you share the same?
No, I don't. I think it's because of the fact that the numbers may look a little bit worrying, but if you look at where we are coming from and the expectation of the market from, in terms of the banking sector's input into the effects of the crisis, I think it was expected. If you look at, for instance, the level of restructuring, one is we need to acknowledge the combined effect of the regulator and the banking sector players. The regulator came in very strongly to support the banks to be able to support the economy during the difficult times of the COVID-19. So some of the prudential guidelines, for example, are relaxed to enable banks to be able to extend accommodation to their borrowers. No wonder banks have been able to restructure almost 50% of the total portfolio. If you look at the total portfolio of 3 trillion and 1.6 trillion being restructured, that's a significant proportion of the total portfolio. It doesn't mean that the portfolio is bad. It only means that at that particular point in time, the customers were having specific challenges. Either their supply chains were disrupted, their demand, on the demand side, they were disrupted, employees could not come to work. All those challenges meant that they were not able to generate the cash flows to be able to repay the obligations. But they required that kind of accommodation to be able to come back and recover. So the 54% is not particularly very worrying. Now, if you look at the non-performing portfolio, in terms of the quality of the portfolio, the 14% may look worrying because at the beginning, before the COVID, it was at about 9.9. So deteriorating to 14.1, which it was at the end of the year, looks a little bit worrying. And so we are hopeful that with the opening up of the economy, with the relaxation of the containment measures and things begin picking up, we'll see the quality beginning to improve as the SMEs that have been accommodated begin to pick up and therefore begin to repaying their obligations.
If I recall very well, when these measures, particularly the restructuring of banking sector loans started, it was for a window period of about a year, which means that we are effectively at the lapse of it. What happens beyond this?
Yes, you're right in the sense that central bank came in with the relaxation of the requirements of compliance to the strict prudential guidelines. And that was for the loans that are performing as at the 2nd of March last year. And it was meant to be for a year, which meant that it was lapsing on the 1st of March this year. So we are just at the point when effectively the measures have lapsed. Now, in terms of going forward, hopefully, central bank may consider and give some additional extension to that date so that even if it's another 6 months or 1 year, because you're not yet out of the woods. And the customers will still need to be accommodated one way or another. And it may be difficult for the banking sector to accommodate them while complying with the requirements of the prudential guidelines. So that is a discussion that maybe central bank may consider. But even without the extension, banks would still find it necessary to continue accommodating the customers who especially just require some bit of hand-holding to get over the cliff, because we see things opening up, and once things start opening up, most of these customers will be able to pick themselves up and start repaying. So it's an issue of, are they going to start repaying in 6 months? Are they going to start repaying in 3 months or even a bit longer? So the banks should be able to extend that kind of accommodation.
COVID started just as we were coming off the rate cap regime, and one of the realities that the rate cap regime precipitated was that then banks were a bit awash with liquidity. How much of a leverage was this in terms of tiding through the COVID-19 reality?
When COVID struck, actually banks were, I would say, well cushioned from two angles. One, as you have mentioned, is the liquidity position of the banking sector, and it is because of the fact that you are coming out of the interest capping regime, which had been repealed in November 2019. So after November 2019, that's when banks were beginning to pick up and start on lending the liquidity that they were already holding. They were awash with the liquidity. Now, so when COVID struck, banks were still in that position of being fairly liquid. Now, the other point that we mentioned a little bit earlier in terms of the position that the banks were in was the adequate capitalization. Banks are fairly well capitalized because if you look at the minimum requirement as per the regulatory capital, we're talking of 14.5%. Banks were operating well above 18 in terms of the average capitalization of the banking sector, well above the minimum requirement by the regulatory provisions. So on the two fronts, in terms of liquidity and capitalization, banks were fairly well placed at the time when the COVID kicked in. And that gave a lot of stability to the banking sector to be able to absorb the shocks that were coming in with the advent of the COVID-19.
Looking then at how we price risk, one of the questions we have now is that we are aware banks have written to the market regulator in terms of guidance. I'm not aware that any feedback has come. As an association, how do you see the future unfolding as far as this pricing is concerned?
One of the reasons why there was the interest capping, the argument was the fact that banks were not pricing their customers on the basis of risk. So the need to introduce a risk-based pricing mechanism within the sector was quite important, and important for banks moving to this mode with the repeal of the interest capping. So we are in that state of each bank trying to develop a model that would have the characteristics of risk pricing. But as you'll appreciate, it's not easy to have a model that covers all the whole sector. So each bank will have to uniquely define a model that still meets the overall requirement, but unique to its own specific needs and circumstances. So banks have developed various models which they were in discussion with the central bank, with the back and forth. So once they have got some generally agreed model, each bank will then be able to offset itself. But even as we get that in place, banks are already having some way of pricing risk into their portfolio. So it may not be the ideal, but at least you've got a starting point before you reach that ideal that has now been agreed between yourself and the regulator.
Banking shareholders watching this will, of course, be wondering, from a NIM's perspective, the fact that those who are still making savings and deposits expect their return in terms of interest. But when it comes to on-lending, then banks are a bit constrained because of the risk profile out there. How do you see that position from a NIM's perspective in the banking sector going forward? Because clearly the market is a bit challenging as we speak.
Going forward, I think growth is going to be generated from the push by the private sector. The productive segments of the economy are the ones that are going to start picking up and therefore driving growth going forward. The public sector spend-led kind of growth may not be quite what we need at the moment. Now, having said that, in terms of the private sector-led growth, that will be fueled by credit. And credit will obviously be coming from the banking sector. Now, the banks will be able to extend credit. The demand for credit will determine their demand for deposits to be able to fund that credit growth. And therefore, the price dynamics between what banks are lending at and what they are able to pick up determines the margins that they are able to maintain on the difference between the deposits and the lending. So the dynamics will be based on the pickup on the demand side in terms of access to availability of credit, and therefore the pool for the deposits to be brought in by the banks. And so the dynamics will depend on how quickly we are able to get the private sector to drive that growth.
I'm sure you're involved in this, the credit guarantee scheme. How far are we with this, and in terms of the impact, what do you anticipate?
Yeah, one of the challenges that we saw during the development of the COVID-19 was the fact that banks were more able to restructure the existing facilities rather than on lend fresh money. Now, on lending fresh money meant that they had to assess the credit risk, and most of the borrowers, potential borrowers, were fairly high-risk borrowers, and all that risk could not be borne by the banks. So there was need for a mechanism where the risk could be shared across banks, taking part of the risk and part of it being offloaded to people who can be able to take that risk on board. Hence the need for such a scheme like the credit guarantee scheme, where part of the risk will be borne by this credit guarantee scheme. Now, and the government took it up. The National Treasury drove the process. We saw some commitment in the budget to the capital for this credit guarantee scheme. There was 3 billion shillings that was allocated to the fund. There was a cabinet decision to allocate up to 10 billion over the 2-year period. So those are good developments, because once it's capitalized, the structure is that banks will be able to leverage on the capitalization of the scheme and lend up to 4 times the capital injected into the scheme. So, and also in the scheme, there is talk of donors showing interest in terms of bringing in the capital. So you can imagine the stock of 12 billion coming in from the donors. There is 10 billion from the government. That's already 22 billion. Now banks are able to leverage on that 4 times. So we're talking about 80 to almost 90 billion shillings that is available for lending to the SMEs on the basis of a scheme that has been developed. Now, if this thing can be expanded further by either injecting in more capital from either the government or from the donors or from any other multilateral agencies that would be interested in supporting the credit growth for supporting the SMEs, then we see this thing becoming much bigger.
Right, and that point by Dr. Habil Olaka takes us to a short break. Business Redefined will be back with a lot more conversation on this subject, focusing on 1 year ever since we began restructuring banking sector loans. Stay tuned. Welcome back to Business Redefined. We are taking stock of 1 year since the banking sector began restructuring loans in light of COVID-19, and we are privileged to have the Chief Executive Officer of the Kenya Bankers Association, Dr. Habil Olaka. Welcome back on set.
Thank you, thank you.
Dr. Habil, one of the concerns that pervades out here right now is the fact that there is a likelihood, in light of the risk profile that exists in the market, that banks could again revert to lending predominantly through government securities as opposed to the private sector. And that's a very rational position to take if you look at the risk out there. Now, what are your thoughts on this, especially if you consider the fact that the government revenue outturn is really falling behind targets?
I think any lender, given the option between the government and lending to the riskier SMEs, of course you'll go for the low-risk government, which is effortless. And therefore, I think it requires quite a bit of effort from the government in terms of fiscal discipline to look for alternative sources of bridging the gap than raiding the domestic market. And one of the alternatives, of course, would be to consider externalizing the debt so that you can give some room to the domestic market for the lenders to really direct the credit to the productive sectors of the economy in terms of the private sector. And as we mentioned a little bit earlier, the growth is most likely going to be driven by the private sector. And the private sector will be, that growth will be fueled by credit from the banking sector. Now, if the market is going to be that banks will then have to decide between lending to this, the productive sector and putting the money in government securities, I think the fiscal discipline comes in very strongly in terms of the fact that you try to create the market in a way that banks will be encouraged to put most of the money flow into the productive sectors rather than to the government.
Great, and I'm not sure I see much of that discipline when I look at the budget policy statement, but let's flip the coin and look at it now from the banking side. Over time, Dr. Habil, the yield curve has been softening because of this fiscal consolidation you're talking about. Granted, we might see an uptick because of the appetite, but generally it's been going down. When you look at it now from the banking's perspective and what this means for your income, The private sector is not doing too well for understandable reasons, so the returns are not as good. Now the yield curve is softening on this side, clearly constraining your alternative income. What wiggle room do you see banks having to play with in terms of diversifying their revenue streams?
Given what is happening, and as you have put it clearly, I mean, the easier option is for banks to stash their excess liquidity in the government securities. And that would be because of the fact that they don't have better options in terms of supporting the economy, especially the private sector for that matter. And that's where now I think the innovation comes in, because of the fact that I think options have got to be brought in a way that it makes it easier for the banks to direct their liquidity to the productive sectors of the economy. That requires them to have various options available in terms of lending to the private sector. And so things like, for example, the risk profile of the borrowers. If the risk profile is such that is perceived to be high, chances are that the banks will not be as amenable to directing their liquidity in that direction, unless if there is a way of mitigating that risk. And we can think of many other innovative ways of trying to mitigate that risk to enable banks extend liquidity to those specific segments. There are some segments that are particularly critical for the economic growth of the country. And now those segments also happen to be the ones that are most risky.
Habil, I must ask you this question, and really out of public interest. Listing on the CRB, what's the position here? Did we go back, and how are the numbers looking like, if at all you know? Because definitely, as you'd imagine, many Kenyans would be curious to understand how this is going on.
I think the whole CRB framework was meant to support the credit market, in the sense that is sharing information about the performance of the borrower, so that you can be able to, as a lender, you can be able to assess based on some credible information. Now, truth be granted, at the time when COVID hit, there was a push for the fact that the entities that were listed would find it much more difficult to access credit in the circumstances, and therefore there was a move to suspend the listing of those that would have defaulted because of the COVID, which was a fair move. But even though it's fair to the borrowers, I think in terms of the lenders, it makes the whole thing be very opaque. You don't have information for you to be able to assess the creditworthiness of the borrower, because the information is not being shared. But I think given what was happening in the market at that point in time, there was some give and take that players had to live with. Now that we are getting out of the COVID, I think the critical thing is to try to reinstate some of those mechanisms that enable the whole system to be able to work. So the information flow should start picking up again. The only thing is the fact that I think we also need to reintroduce it in a way that it does not penalize some specific individuals or players who are significantly impacted by the COVID, to enable them come out of the COVID crisis. Otherwise, if you're going to have that information just onboarded and therefore used for purposes of denying the borrower access to credit, it becomes counterproductive. And I think the critical thing is the discipline also of the players, in the sense that that information that you have about a player's performance during that period of COVID does not mean that that person is not creditworthy. It's just useful information for you to be able to assess the capacity of the borrower to be able to repay going forward, which does not necessarily depend on his performance over the COVID period.
One of the key sources of income for banks, aside from interest, is foreign exchange. And if you remember, last year we had a bit of a very wild Q3 going into Q4, but now we've seen the stabilization of the shilling. What's your outlook, and how do you think this will impact the banking sector?
We should laud the efforts that were put in by the regulator, and that's the central bank, in terms of price stability. And in particular, in this case, you're talking about the exchange rate as a price, the stabilization of that exchange rate. You see, if the exchange rate is not stable, The actions of the players in the market make it even more unstable, partly because they cannot anticipate the price of the dollar, for example, tomorrow. If I'm an importer and the price is unstable, what I do is that I try to buy the dollar today at a higher price, because I anticipate the dollar to be higher in terms of the exchange rate tomorrow. And if I'm an exporter and I'm also holding on to some dollar proceeds, I will hold on to them because I anticipate the dollar to give me more shillings tomorrow. The actions of these players in the market just make the shilling even worsen, not because of an economic activity, but because of the actions of the players. Now, and that's why it's important for the shilling to be stabilized. The stability of the market is very, very important in terms of sending signals to the players and also enabling the market to operate in an efficient way. So I think the actions taken by the central bank over this period are laudable, in the sense that we have seen a very stable shilling. There were some times when there was a bit of volatility, but quickly actions brought the shilling back to stability. My outlook in terms of going forward, central bank has got adequate reserves to be able to intervene at any point when the shilling appears to be becoming volatile, maintain and achieve the stability, and then pull out. So as long as you have got adequate reserves, and from the last figures I saw, we have got quite a bit of, in terms of the import cover, we have got adequate, and therefore we should be able to stabilize the shilling going forward for 2021 and possibly even into 2022.
Right, on that point by Dr. Habil Olaka takes us to the close of our conversation on Business Redefined, where we have been taking stock, I should say, of 1 year ever since the banking sector began restructuring and reprofiling loans in light of the COVID-19 shock. Up next is the Markets Report.